The Federal Reserve is trapped, not metaphorically, not as an editorial opinion, mathematically, mechanically, provably trapped, in a position where every option it has available produces an outcome that is structurally bullish for gold and silver. Every single option. There is no policy path the Fed can take from its current position that does not push both metals higher over the next 24 months. I want to say that again because it is the most important thing I am going to tell you today. There is no Federal Reserve policy decision available right now that does not benefit gold and silver holders. Not one. And I am going to prove it to you with math, not with opinion, not with chart patterns. With the actual arithmetic of the Federal Reserve's balance sheet, its inflation mandate, its employment mandate, and the dollar's reserve currency obligations, all four of which are in direct conflict with each other right now in a way that has never happened simultaneously in the Fed's 112-year history. If you hold gold, you need to understand this trap because it tells you that the $6,000 gold target is not a bull case aspiration. It is the mathematical output of the Fed's own constraints. If you hold silver, you need to understand what $6,000 gold produces in the gold-silver ratio framework, and the number is one that should fundamentally change your conviction level in your silver position right now. Here is the structure of today's video. We cover the Fed trap mechanics, all four conflict points with specific numbers. We cover the two policy paths available and what each produces for gold and silver mathematically. We cover what silver does specifically in each Fed path scenario. We cover what the bond market is telling us about which path is more likely. And we cover the specific positioning framework for capturing the move that the Fed's trap has already locked in. Let's go. The Federal Reserve has a dual mandate: price stability, keeping inflation near 2%, and maximum employment. Those two mandates have historically created occasional tension. But the Fed trap of 2026 involves four simultaneous conflicts, not two. The additional conflicts come from the Fed's role as the manager of the dollar's reserve currency status and from the mathematical reality of U.S. debt service. Conflict 1. Inflation versus employment. Current inflation, as measured by the CPI, is running at approximately 4.1%, more than double the Fed's 2% target. Simultaneously, the labor market is showing signs of softening, job openings declining, initial jobless claims rising, the leading employment indicators pointing toward a slower employment environment in the next 2 quarters. To fight inflation, the Fed should keep rates high or raise them further. To support employment, the Fed should lower rates or at minimum signal dovish intent. Both mandates are pulling in opposite directions simultaneously. This is the traditional Fed tension. It is not new, but it is the foundation of the trap. Conflict 2. Debt service versus rate policy. The U.S. federal debt is approximately $35.8 trillion. The weighted average interest rate on that debt has been rising as lower rate bonds issued during the zero-rate era mature and are refinanced at current higher rates. The Treasury's annual interest cost has crossed $1.1 trillion, more than the entire defense budget. If the Fed keeps rates at current levels, debt service costs continue to grow, and the Treasury's financing burden accelerates toward a level that crowds out other spending or requires monetization. If the Fed raises rates further to fight inflation, debt service costs accelerate even faster. The Fed's rate policy is directly constraining the Treasury's fiscal ability to function, a conflict that the Fed cannot resolve without choosing whose pain to take. Conflict 3. Dollar reserve status versus domestic monetary needs. The dollar's global reserve currency status creates an external obligation. The world holds approximately $7.4 trillion in dollar-denominated reserves and $2.3 trillion in U.S. treasuries held by foreign central banks. If the Fed eases monetary policy significantly, cuts rates, resumes quantitative easing, it weakens the dollar and reduces the attractiveness of dollar-denominated reserve assets. Foreign central banks that hold treasuries see the real value of their reserves erode. This accelerates the de-dollarization trend, the reduction of dollar holdings in global reserves, that is already underway. The Fed's domestic monetary easing needs conflict directly with the dollar's global reserve currency obligations. Conflict 4. The banking system versus market stability. Regional bank stress, the same stress that produced bank failures in 2023, has not fully resolved. Several regional banks continue to carry underwater bond portfolios that are manageable only as long as they are not forced to sell. If the Fed keeps rates high, those portfolios continue to deteriorate, and the risk of additional bank failures remains elevated. If the Fed cuts rates to relieve banking system pressure, it signals dovish intent that reduces the credibility of its inflation-fighting stance. The banking system's structural vulnerability and the Fed's inflation credibility requirement are in direct conflict. 4 simultaneous conflicts. No single policy tool resolves more than one without worsening the others. Given four unresolvable conflicts, the Fed has two broad policy paths available. Let me walk through each and show you precisely what each produces for gold. Path 1. The Fed keeps rates high and prioritizes inflation fighting. In this scenario, inflation gradually declines toward the 2% target over the next 12 to 18 months. However, the consequences of Path 1 include debt service costs continue to accelerate, and the Treasury faces growing fiscal pressure. The banking system remains stressed, and bank failure risk persists. The employment market weakens as high rates slow economic activity, and the dollar remains elevated, which continues to put pressure on emerging market economies and adds geopolitical incentive for de-dollarization. What does Path 1 produce for gold? A weakening economy increases gold's monetary demand as investors seek safe haven assets. Persistent banking system stress increases gold's safe haven demand. The ongoing fiscal pressure on the Treasury, as debt service exceeds $1.1 trillion annually, raises concerns about long-term Treasury sustainability and increases gold's relative attractiveness as a reserve asset. Central banks that are already diversifying away from treasuries accelerate that diversification as Treasury sustainability concerns grow. Path 1 gold outcome: sustained demand from monetary fear, banking system stress, and sovereign reserve diversification acceleration. Gold in Path 1 likely tests $5,500 to $6,000 over 18 to 24 months as the fiscal stress and monetary fear compound. Path 2. The Fed cuts rates and prioritizes employment and banking system stability. In this scenario, inflation stops declining and potentially re-accelerates as cheaper money enters the economy. The dollar weakens as rate differentials with other major economies narrow. Real interest rates, the nominal rate minus inflation, move negative or deeply negative as inflation holds above the nominal rate. What does Path 2 produce for gold? Historically, negative real interest rates are the single most reliable macro environment for gold appreciation. In every period where real rates turned negative and stayed negative, the 1970s, 2011, 2020 to 2022, gold made its most significant gains. Path 2 creates the most directly gold-favorable interest rate environment that the Fed can produce. Dollar weakness in Path 2 adds the currency tailwind. When the dollar falls, gold rises in dollar terms even without any change in gold's physical demand. And re-accelerating inflation increases gold's monetary hedge demand from individual and institutional investors simultaneously. Path 2 gold outcome: negative real rates plus dollar weakness plus inflation hedge demand produces the most aggressive gold appreciation scenario. Path 2 gold likely tests $6,000 to $7,400 over 18 to 24 months. The conclusion: both policy paths produce significantly higher gold prices. Path 1 produces $5,500 to $6,000. Path 2 produces $6,000 to $7,400. The range of outcomes, from the perspective of a gold holder, is not will gold go up? It is which path produces the larger gold move. Both paths go up. The Fed is trapped into a policy choice that benefits gold regardless of which direction it chooses. Now let me run the silver math for each path because silver's behavior in each scenario has important distinctions from gold. Path 1 silver scenario: rates stay high, economy weakens, inflation gradually declines. In this environment, silver's industrial demand is partially affected. A weakening economy reduces some discretionary industrial activity. However, and this is the critical point, silver's primary industrial demand drivers, solar, EVs, defense electronics, semiconductors, are not economically discretionary. Solar installation projects funded by government mandates and private capital that was committed years ago do not stop because the economy slows. Defense electronics procurement programs run on multi-year contract cycles that are not paused by a softening labor market. The inelastic component of silver's industrial demand creates a floor that Path 1's economic slowdown cannot penetrate. In Path 1, silver's industrial demand floor holds while the monetary demand from gold's safe haven appreciation creates a secondary demand stream. The gold-silver ratio, which is currently at 61:1, compresses as gold's safe haven appreciation begins to pull silver's monetary premium higher. If gold reaches $5,500 in Path 1 and the ratio compresses to 50:1, silver is at $110. At 45:1, silver is at $122. Path 2 silver scenario: rates cut, inflation reaccelerates, dollar weakens. This is the historically most favorable silver environment. Silver's industrial demand remains fully intact. Accommodative monetary policy supports economic activity, and does not threaten the inelastic demand drivers. The reaccelerating inflation environment creates significant monetary hedge demand for silver as an inflation protection asset. Dollar weakness adds currency tailwind. And the gold move in path 2, towards $6,000 to $7,400, creates powerful ratio compression pressure. If gold reaches $7,000 in path 2 and the ratio compresses to 35-1, still well above the 2011 cycle low of 31, silver is at $200. At 25-1, silver is at $280. Path 2 creates the conditions for the most extreme silver appreciation in the framework. Both paths produce significantly higher silver prices. The Fed's trap locks in a policy environment that benefits silver regardless of which direction it resolves. The key variable is magnitude. Path 1 produces more moderate silver appreciation in the $100 to $130 range. Path 2 produces more extreme silver appreciation in the $180 to $280 range. The bond market is the most sophisticated aggregator of macroeconomic expectations in the world. The collective intelligence of the people managing trillions of dollars in fixed income, who profit from being right about the direction of interest rates and inflation, is reflected in the yield curve, the TIPS market, and the forward rate structure. Let me show you what that collective intelligence is currently saying about which of the Fed's two policy paths is more likely. The yield curve is currently inverted. Short-term rates are higher than long-term rates. An inverted yield curve is the bond market's way of saying, we expect these short-term rates to come down. The market believes the Fed will cut rates. That is a bond market vote for path 2, not path 1. The TIPS break-even inflation rate, the difference between nominal Treasury yields and TIPS yields, is currently at approximately 2.8%. The bond market is pricing inflation at 2.8%, which is above the Fed's 2% target and shows no sign of falling to target without a policy change. If the bond market believed path 1, that staying high would bring inflation to 2%, it would price break-even inflation below 2%. The fact that break-even inflation is 2.8% and sticky tells you the bond market does not believe path 1 works. The forward rate curve, the market's expectation of where rates will be at specific future dates, is pricing approximately 75 to 100 basis points of rate cuts in the next 12 months. The bond market is not just voting for path 2, it is pricing exactly how much path 2 the Fed will deliver. Bond market verdict. Path 2 is the more likely outcome. Rate cuts, not sustained high rates. Inflation staying above target, not returning to 2%. Dollar weakness, not sustained dollar strength. Path 2 is the silver bull scenario. Path 2 is what the most sophisticated market in the world is pricing as the most likely Fed policy direction. And Path 2 produces silver in the $180 to $280 range at the historical ratio compression levels that prior cycles have achieved. The bond market has seen the Fed's trap. It has made its probability-weighted assessment of how the trap resolves. And its assessment is that the Fed cuts, inflation persists, and real rates go negative, which is path 2. The same path that produces the largest gold and silver price appreciation in the framework. Let me now give you the practical positioning framework because the Fed trap analysis produces clear and actionable conclusions for both metals. The core insight is this: both paths are bullish for gold and silver. Path 1 more modestly, path 2 more aggressively. This means the correct positioning is not to wait for clarity on which path the Fed chooses. The correct positioning is to be in both metals now, sized appropriately, before the Fed's hand is forced. Because by the time the policy direction is clear to everyone, the markets will have already priced a significant portion of the move. For gold, the minimum upside case, path 1 at $5,500, represents a 16% gain from current prices of $4,726. The central case, path 2 at $6,000 to $7,400, represents a 27% to 57% gain. Gold in an unleveraged physical position with a 24-month holding horizon has a risk-reward profile that is exceptional. The downside is bounded by the fact that both policy paths are structurally bullish, and the upside is 16% to 57%, depending on which path materializes. Physical gold here, held without leverage and without a forced exit timeline, is as close to an asymmetric position as exists in major markets today. For gold miners, the margin expansion math at path 1 prices produces free cash flow growth of 30% to 50% for senior producers with $1,200 to $1,400 all-in sustaining costs. At path 2 prices, the free cash flow growth is 70% to 150%. The equity market, which prices miners on a combination of current free cash flow and expected future earnings, has not yet re-rated miners to reflect even the Path 1 scenario. Quality senior gold producers are trading at multiples that are historically cheap relative to their current free cash flow generation at $4,726 gold. The re-rating, when it comes, adds multiple expansion on top of earnings growth. The combination has historically produced 3 to 5 times the gold price appreciation in mining equities during the peak phase of the cycle. For silver, in Path 1, position in physical silver and quality senior silver producers for the $110 to $130 scenario. In Path 2, which the bond market says is more likely, position for the $180 to $280 scenario. The sizing should reflect the bond market's probability weighting, more exposure to the Path 2 upside scenario, hedged with the knowledge that even Path 1 produces significant silver appreciation. A portfolio that holds physical silver plus quality senior silver mining equities is positioned to capture significant upside in both paths without requiring a specific prediction of which path materializes. The Fed's trap is not a problem for gold and silver investors. It is the best news this market has received in years. When every policy option available to the world's most powerful central bank produces the same directional outcome for an asset you hold, you are in a position that requires patience and conviction, not precision timing. The summary. The Federal Reserve is mathematically trapped in 4 simultaneous conflicts: inflation versus employment, debt service versus rate policy, dollar reserve status versus domestic monetary needs, and banking system stability versus inflation credibility. No single policy tool resolves more than one without worsening the others. 2 policy paths available. Path 1, keep rates high, produces $5,500 to $6,000 gold and $110 to $130 silver over 24 months through monetary fear and fiscal stress channels. Path 2, cut rates, produces $6,000 to $7,400 gold and $180 to $280 silver through negative real rates, dollar weakness, and inflation hedge demand. The bond market, the world's most sophisticated macro forecaster, is pricing Path 2 as the more likely outcome. Inverted yield curve, 2.8% break-even inflation, and 75 to 100 basis points of priced rate cuts all confirm the Path 2 probability. Positioning, both metals in both paths. Physical gold and silver as the counterparty risk-free foundation. Quality miners in both metals for operating leverage and free cash flow multiple expansion. No leverage, appropriate sizing, 24-month holding horizon. The Fed has trapped itself. Gold and silver holders are the beneficiaries of that trap, regardless of which direction the Fed chooses. Subscribe to this channel. The next Federal Reserve decision is one of the most important catalysts for both metals that we have covered. We will analyze every signal and every implication in real time as it develops. Comment below, which Fed path do you think is more likely, and what is it doing to your positioning right now? Tell me your analysis.